So good evening, ladies and gentlemen. A warm welcome to all of you at ASK Investment Managers Quarterly Call. I am Gaurav Chakravarti and I'll moderate today's call for you. As you all know, with a population of more than 1.4 billion, India is the world's largest democracy now, and now India has also emerged as one of the fastest growing economies in the world. Despite the significant challenges we have faced in the global environment, including renewed disruptions of supply lines following the rise in geopolitical tensions, the synchronized tightening of global monetary policies, and of course, the inflationary pressures. Over the past decade, the country's integration into the global economy has been accompanied by stellar economic growth. And in its true level, India has now emerged as a global player. India has now experienced strong macroeconomic and financial stability with a steady pickup in the momentum of growth. And that forms a part of our discussion today. And for that, we have Mr. Sandip Bansal, Senior Portfolio Manager at ASK Investment Managers, with us to assess the condition prevailing in the global and domestic market. And he shall take us through the highlights of our ASK Growth portfolio as well. ASK Growth portfolio is one of the industry's first PMS investment approach, launched way back in 2001 and now has a track record of more than 22 years. And in this period, it has compounded at a rate of 18.5%. Sandeep comes with a 2 decade of work ex with more than 15 plus years experience in the equity market itself. He has been instrumental in managing our growth portfolio since the time he has joined us from SBI Life, where he was head of investment research, leading across asset classes. He comes with a strong educational background. Sandip is a chartered accountant, company secretary, and an MBA from IIM Ahmedabad. Today, we have scheduled an hour for this webinar, where I would request Sandeep to cover broader trends of the market and the growth drivers for Indian economy, followed by a deeper understanding of the ASK growth strategy, insight on what happened in this financial year so far, where you stand now, and how you see things going forward. Reminder, friends, this will be followed by question and answers. So I request all the participants to type in your questions and queries, and we shall curate and try them answered. Over to you, Sandeep.
Thank you so much, Gaurav. Welcome, friends. Thanks a lot for joining this call. I will just share the presentation, and Gaurav, please do let me know once it's visible.
Sure. Yeah, it's visible. You just need to put it into full screen mode.
Sure. Just starting off on the market outlook, it is not just that Indian markets have done well. If we look at, 1-year returns or calendar year-to-date returns, we find that India is somewhere in the middle of the pack. Globally, a lot of markets have done well this year, and India is somewhere in the middle of the pack. When we look at the longer term story, therein we find that India tends to, outperform the other markets. So while 1-year returns are between 6 to 8% for India, 3 to 5-year returns are in double digits and much better than most of the other developed or developing nations. So, this kind of highlights that the long-term story for India is good, while, over the last 1 year, equities as an asset class across markets perhaps has done well. Now, what is the key reason for equities doing well? 3 key elements to it. Firstly, sentiments. Sentiments have been aided by global inflation coming off. So if we look at this chart, friends, the dark blue bars represent inflation levels across various geographies last year, which was, let's say, October 22. And the light blue bars represent inflation levels in October 23 of this year. And, across geographies, we've seen that inflation has come off anywhere between, 4 to 6%. And this has kind of buoyed sentiments for equities. Now, why has inflation come off? One of the key drivers for the moderation in inflation has been commodity prices, whether it be soft commodities or hard commodities, or to some extent even energy prices, coming off from their 52-week high levels. If we look at it, the entire commodity basket is down anywhere between 5 to 30% now over the last 1 year from its 52-week highs. This is even more important for a commodity hungry, energy hungry young country like India, which requires obviously all of this to fuel its growth. The one of the key elements for the Indian growth story is obviously energy prices and crude prices. Let's say till some time back when crude had kind of gone up quite sharply, it had rallied about 34%. It was some cause for worry. But we are seeing that crude is now down by around 19% from its local kind of peak levels, or recent kind of peak levels, and that in some sense has aided sentiments in India as well. In this chart, friends, what we've tried to do is we've shown the global inflation levels, which is this dark blue line, along with the central bank rates, whether it be the Fed's funds rates, which is this light blue line, or the yellow line, which is the ECB rate. While inflation has come off, we've seen that the US Fed has taken a second consecutive pause in its hiking cycle, after increasing rates, by around 525 basis points. So, interest levels are perhaps at the highest levels since the global financial crisis. Now, this pause, what it has done is that it has stabilized the global cost of capital in some sense. So, after sentiments, the other important thing is liquidity. And, from a liquidity perspective, once the global cost of capital stabilizes, it kind of gives confidence to investors that, now they can take maybe a more longer term view and maybe a relatively more assured view on equities versus the case when interest rates were rising and one did not know as to how more it could go. And the ECB kind of holding on rates for one meeting has also kind of added to this entire global sentiment of the cost of global capital stabilizing. We've seen this in India as well, wherein RBI has taken successive pauses in its interest rate hiking cycle, and this has aided the liquidity environment per se for equities. Anyways, globally there's a lot of liquidity sloshing around, given the pumping of money that we'd seen during COVID times. So, this is also reflected in the US government bond yield. After reaching 5% kind of levels, we had seen some moderation, wherein US government 10-year bond yields had come down to around 4.5% range. The other important aspect for as far as domestic liquidity is concerned is the money that we are seeing flowing into equity markets from domestic sources. So this chart captures SIP flows into mutual funds, and we see that since the level of 2.5 years ago, which was, let's say, around 8,000 crores or so, monthly SIP flows are like about 17,000 crores, which is about double the number 2.5 years ago. In addition to this, we need to add in sticky flows for provident fund, pension, and some part of insurance money is also sticky. So broadly, one could say that about 20,000 crores, or roughly $2.5 billion of relatively sticky money, is continuing to flow into Indian equity markets, which is aiding liquidity and buying sentiments at the same time. The third important aspect for equity markets is fundamentals. And as far as fundamentals are concerned, India will continue to be the fastest growing economy this year as well as next year, which is going to be about double the rates of the global average. So if we look at large economies, there are really not many geographies that are available, which are going to grow as fast as India. And so we believe that India is likely to continue to draw over the long term a good share of global capital as well, because they will come in search for growth and yields. And India, in that sense, is the place to be. So, how does this good, buoyant economic growth environment translate into earnings? So, in this chart, we've captured the growth of Nifty earnings per share. And, what we see is that earnings for Nifty or profits for Nifty companies is likely to grow at a mid-teen plus kind of a range, a 19% kind of a growth rate over 24 and 25. And the first half results that we've already seen so far, we've kind of tracking this number quite well. So, all the three key elements of a buoyant market in terms of liquidity, sentiments, and fundamentals are with us for now. And, we've seen historically what a rising profit scenario does. So, in this chart, the blue bars are the annual corporate profits, and this light blue line is the market cap. And, we see that as profits rises, obviously it kind of reflects in the market capitalization of the underlying companies. Now, the last bit on the market outlook, where are we on valuations? So, this is the 1 year forward price to earnings chart of Nifty. P is typically the valuation multiple that we look at while looking at, the market valuation levels in an overall perspective. So the dark blue line is the average line. Obviously, we are, quite above the average, and we are closer to this light blue line, which is, one standard deviation above the average. So what we can say is that, we are definitely not cheap from an historical market level perspective. Maybe we were cheap during 2008, maybe during 2013, or maybe even for a brief period in 2020. But what we can also see from this chart is that we've been at higher levels previously. The other aspect is that given that the structurals of the market are improving, in the sense that the component of higher quality and faster growing companies in the benchmark are increasing, then maybe the valuation multiple itself is has gone up from its historical average levels. So, maybe the levels which were more like 15 to 16x historically, maybe those levels itself need to go up given the changing component of the index. So, given the good growth outlook in earnings, given the liquidity environment, and given the buoyancy surrounding the long-term India growth story, the valuation levels could likely sustain. What were our key takeaways from the quarterly results that just went by? These are important takeaways to highlight. So firstly, the investment side of the economy continues to do well. We saw this in the Q2 results as well. Steel and cement consumption are growing at about 7 to 8%, and the commentary from the capital goods companies, the infrastructure companies continues to be good. The consumption side of the story was a bit muted. Exports remained a drag. The financial services sector, they performed well and in line with expectations. The chemical and pharma companies witnessed pressure due to lower export volumes, and there was also some compression in spreads. IT company results were muted, but that was in line with expectation, given the fears of a slowdown and perhaps a recession in the US. There have been some concerns around IT spending. Luckily, we are underweight on that sector in our portfolio. The pharma companies delivered better than expected results, primarily on the back of good volumes on the domestic market, and lower input costs aided their margins. The auto sector delivered again good margins on the back of lower input costs, and volumes helped operating leverage as well. Consumer discretionary sector remained a bit muted because there was a shift of a few months, a month or so in the festive season. So this was in summary the Q2 results. What is the market outlook from the company's perspective that we get to hear from them? So managements did talk about a pickup in consumer demand towards the end of the quarter. So September was relatively better for them versus August and July, and which kind of give them hope for the upcoming festive season. The festive season has been, the commentary that we are getting, and from the ground, the feelers that we got is that the festive season was good. Capex investments are likely to sustain. So that growth trajectory remains upward. As far as the export sector is concerned, primarily on chemicals, pharma, and a lot of the commodity kind of sectors, what we had seen was that China's export volumes had picked up quite a lot in the first half of the year, and that depressed prices and in turn volumes for Indian exports. That scenario is likely to alleviate itself from Q4 onwards. So things are likely to stabilize in this quarter, and then we are going to see a pickup from the fourth quarter. Lower input costs driven margin expansion is likely to continue. That is a trend that we saw last quarter, and that is the trend that we are likely to see to continue in the second half as well. The key things to watch out for, given that the Kharif season was not that great, Rabi is something that we'll watch out for, because food inflation has been a key driver for inflation in India. The other aspect is geopolitical concerns. There seems to be some alleviation, at least on one conflict. We really don't know how that is going to last, so we are watchful about that. Secondly, the markets, would be focused on how the results for the elections in the states pan out to take cues about the general election from them. So this, in a snapshot, was the macro outlook. Now we'll come to the portfolio. As far as the portfolio earnings are concerned, they were at around a 35% kind of growth level versus that of Nifty of around 22%. So, on that metric, the portfolio continued to track well. This was both at the PAT level as well as the operating profit level. The forecasts going forward are also that the portfolio earnings growth is likely to be better than that of the underlying market, both in FY24 as well as FY25. Some of the key actions that we've taken in the portfolio is that we've added stocks like IndusInd Bank, SBI, Indian Oil Corporation, KEI Industries, Bharat Electronics, L&T, PI Industries, and JSW Infrastructure. Net, if you see, the key takeaway from this slide is that we've kind of increased the component of the capital investment side of the economy, wherein we see continued momentum, which we believe is going to continue for the next few years. If we look at the key portfolio psychographics, we look at earnings, which is going to grow at roughly about 25% CAGR for FY24 as well as 25, which let's say compares with around 18 to 19% CAGR for Nifty. If we look at the return on capital employed, we are looking at a 13% plus kind of a return on capital employed for the underlying portfolio as a whole. So the companies are likely to generate sufficient internal accruals to fund this growth. And this return on capital employed metric continues to be superior versus that of the market. The debt to equity ratio or the balance sheet profile of the underlying businesses is also quite good, uh, with debt to equity levels at around 0.1 to 0. So the companies are likely to generate enough free cash to fund their own growth. The P ratio of the portfolio is obviously higher than that of the market, given that all of the other metrics are superior. And obviously, that does command a higher valuation multiple. So if we look at a 1 year forward multiple for the Nifty, that will be roughly around 20 times or so, while that for the portfolio, would be more like 24 to 25x. If we look at the historical earnings growth of the portfolio companies, uh, we've looked at the last 5 year earnings growth of the portfolio. Uh, Therein, we find that while the market earnings grew at around 16% between FY18 to FY23, the portfolio companies grew their earnings at about 24%. Our going forward projections for the portfolio are on similar lines. So the portfolio has delivered good earnings in the past, and we expect that the same scenario to continue going forward as well. If we look at the market cap breakup of the portfolio companies, while we do not invest based on market cap, we go ahead and select stocks actually on a completely bottoms up basis. We believe that market caps are largely an outcome. What we find is that uh, the large cap composition of our portfolio is about 60 to 65%. So roughly 2/3 of the portfolio is comprised of large caps. Mid caps are around 1/3 of the portfolio, around 30%. Small caps are around 3%. We continue to remain market cap agnostic investors in this portfolio. Whenever we find a good business, whether it be a small cap, mid cap, or large cap, if we are convinced about its long term growth potential and it continues to meet our quality parameters on return on capital, balance sheet, free cash flow generation, management quality, we will go ahead and invest in that. So this composition could change. Having said this, given the investment style, it is quite likely that the portfolio is likely to have a relatively larger proportion of large caps, because they have a more demonstrated historical track record, and they have leadership positions which they've acquired and built over a period of time, and they kind of meet our quality parameters better than relatively smaller companies. If we look at the portfolio composition, what we see is that around 1/3 of the portfolio is comprised of the banking and financial sector, around 38% or so. The banking or financial sector continues to be the dominant sector in the economy as well as the markets. Within this, we have a larger share coming from the banking space. Uh, we also have one NBFC. Overall, if you look at it, this space, what we've seen is that the banking sector has delivered good results. And while margins for the sector might seem to have peaked out, credit growth is likely to continue to do well. And as far as the asset quality cycle is concerned, that is likely to remain benign for at least some more time. So, herein, we are expecting a good earnings growth to come from this 30% kind of portfolio allocation that we have. Good steady earnings growth. Then around 1/4 of the portfolio is comprised of infrastructure, industrials, engineering, construction, basically the investments or the capital expenditure side of the economy, wherein the growth rates are likely to be higher, because this sector has been driven both by largely by government expenditure and to some extent also by private expenditure, whether it be in terms of house building or factory construction, etc. Herein we have a number of sub sectors which we are exposed to. It could be cables, it could be cement, it could be a diversified infrastructure play, it could be a ports player. But all of these businesses are largely leadership businesses that continue to generate good returns on capital with a high growth outlook. This is a space where, if we find comfortable valuation levels, we could look at perhaps increasing our exposure as well. Then around 20% of our portfolio comprises of consumption. Consumption continues to be a relatively good long-term story for India, given the demographics, wherein the visibility remains high. Obviously, the valuations for this space, given the high visibility, is also relatively higher versus the rest of the market. This comprises roughly 1/5 of our portfolio. Then the other larger sector for us relatively is chemicals. Chemicals, unfortunately, has been one of the sectors which has hurt our performance also, because of the inventory destocking cycle that we've seen in China over the last few months, and also because of, let's say, maybe a few company specific issues. The chemical sector dragged down the overall portfolio performance, but the longer term story for the sector remains very robust. We have seen that large economies do have a large chemical sector, and India's own requirements are quite huge. So given this entire drive on self-reliance and import substitution, that provides a good growth lever. Plus, there is a very good growth potential coming from global diversification of supply chains, whether it be China plus one or Euro plus one. So in spite of these transitory issues that we've seen in recent times, we believe that the long-term potential remains intact. In terms of our exports sectors, purely export sectors from a pharma perspective is 4%. Telecom is a 5% exposure for us. And oil and gas is another 8% exposure, where we've also recently added a position in an OMC. So, overall, the earnings growth outlook continues to be good. As I said, the portfolio composition remains quite diversified. We've increased the composition towards industrials and engineering, and we continue to evaluate more opportunities which can give us a higher earnings growth at reasonable valuations meeting our quality parameters. So thank you, friends, for your patient hearing. I would be glad to answer any questions that you might be having. Thanks a lot.
Thank you, Sandip, for a detailed brief on the markets and the portfolio and sectors as a whole. I request all the participants to type in your questions on the chat box, and we shall try to curate all of them. Sandip, in the meantime, we already got some questions in advance from our investors and partners. So I'd like to request you to share your thoughts on the questions being raised or the queries which has been raised so far.
Sure.
The first question would be like, though you have completely, spoken about that we are market cap agnostic, ASK as a house, but there's a classic dichotomy right now, in the markets that large caps will do good, mid caps has already done good, so mid cap or small cap or large cap. So in that context, if we have to place in our portfolio and from the choice of investors, how they will be getting benefited if they get synced to our style and they get the best of the benefits of both large, mid, or small, whatever you say. So what's your take on that?
We invest based on the strength of the business. We believe that market caps are an outcome. So if we find a good, strong business, we will invest in it irrespective of its market cap. Obviously, there are phases in the market where a certain sector or a certain theme or a certain market cap, is relatively preferred. This could be driven by the fact that, let's say if it's a theme or a sector, maybe very good earnings growth is coming there, or there is very good long-term story, or there is a series of continuous positive news flow. Sometimes good performance itself can lead to good sentiments and good buoyancy. Sometimes it could be the fact that that sector or that market cap space or that theme is relatively undervalued, and then that is favored by the markets. It could be a combination of all of these factors as well. We have seen mid caps and small caps, especially small caps. They've done very well over the last few months. It was driven by a combination of all of these factors. In few cases, the earnings growth was very good. In few cases, valuations were really depressed. In few cases, the longer term theme or the outlook was great. In few cases, there was a lot of positive news flow, and hence anticipation of future earnings, etc., etc. What we look at while selecting a stock is earnings growth over a relatively longer period of time, which is 3 to 5 years. If we believe that earnings growth are likely to sustain over this period, then, and it meets our quality parameters, we would like to invest in that stock. We So, given that this is a flexi cap fund, an investor in this fund has the benefit of the fact that we could invest in any market cap. The corollary to this is obviously that, if a certain theme does very well, then, versus that particular theme, we might not look that great. So let's say in recent times when small cap index or the small cap stocks have done far better, because we were not present in that space in some sense, there's just one exposure. Or let's say the mid cap space has done very well and we are relatively, the portfolio skew is relatively more towards large cap, then obviously, during such phases or during such times, on a relative basis, the performance kind of does not stack up. But over a period of time, we believe that if the stock selection is based on good underlying businesses, then these themes even out, and ultimately over the long term, stock price performance we've seen kind of matches up to earnings growth, and given the quality of the companies that we invest in, we believe that this should get reflected.
Sure. Thanks for your answer on the same. I'll come on to a different aspect altogether. At ASK, we always speak about size of opportunity of the businesses. Like in recent times, we are finding a lot of new age businesses are coming. We are also aligning ourselves to that, a theme as well, whenever it's possible, as per the, psychographics which we give into our set of companies. So how do we generally identify the size of opportunity in specific to these new age businesses? And probably, they can gain scale further in the future, like we have done, because this portfolio is a 22-year-old portfolio and we have been, consistently doing it. So what can be the formula, like going ahead, how to identify the size of opportunity for this new age businesses in specific, if you can, throw some light on that.
Sure. So, that's a great question, Gaurav. So, obviously, whenever a new age business comes in, the estimation of the size of opportunity involves a large number of variables for which the amount of information that is available might not be very high. So, the degree of estimation or subjective judgment that one needs to put in is obviously relatively higher versus mature businesses or businesses wherein a lot of data, information, inputs are available. So we go about by accessing a lot of databases, information from ancillary associated industries or businesses, global examples, how has this panned out in other countries which have a similar kind of a profile like India, speaking to company managements, looking at industry or association reports, government reports, initiatives, announcements, and all of that. Given that we tend to do a lot of work and detailed work before kind of firming up our judgments, it might take slightly more time. But before entering a stock, we want to be relatively more sure. So obviously it's a sizing the opportunity for new age business is relatively tougher, but obviously to that extent it is more exciting as well, and it provides a greater opportunity also. So maybe one could take an example, let's say, of the EMS industry. So in the EMS industry, while it's not a very not so young an industry because it's been around for a while, uh, but given that there is a lot of focus on the industry now, and this is just to demonstrate an example, maybe one of the things that one can look at is what is the kind of imports that India is currently doing, how much of those imports are potentially substitutable given the current expertise that we have. Uh, then on top of that, what is the kind of export opportunities that could be available uh, going forward? What is the kind of industry that is there in other regions in Asia? China is obviously the biggest example out there. Then we also look at what are the companies themselves says about the potential opportunity that they can gather. What is the size of companies, the top companies in the sector, and what are their revenues? So these are the various parameters that we use, which kind of help us identify the size of opportunity.
Sure, thank you for that. Now comes in, I'll club. We already got 2 questions on the chat box. In the meantime, and again, request all the participants to type in your questions on the chat box. We shall try and answer them. Now, this financial year in specific, and I'll club 2-3 questions together, wherein all boils down to one thing about the performance. In terms of how we have fared compared to the benchmark as well as compared to the relative underperformance, and also from the context that in the same philosophy we have launched an AIF also, Growth India Fund, and we have been taking the drawdowns of that of late as well. So here, recent times specific to this financial year, few drag from 2022 as well as from 2023. This year has been very tricky for us. So I agree that in the recent past we have done a lot of changes, and I'm sure we expect a good turnaround from them, considering from the point of view that we has always talked about good quality businesses, good ROC, PAT, and that forms the bedrock of our investment philosophy. And also the earnings growth has been very solid for us. So despite that, the performance has been tricky, more so in the last financial year. So you can throw some light on that and also help us understand that with the recent changes, obviously there are some detractors because of which the performance has gone down. So you throw some light that with the new changes which you have done in the recent past, and also how you see through the segments, the sectors, or the stocks which have not, rather they have been neglected by the market, are going to get good positive momentum for the market, and how soon that can be seen in terms of the performance again.
Sure. So obviously FY23 wasn't a great year wasn't a good year for us for sure. FY24 so far we've been tracking fine in the sense that the performance as we speak is kind of in line with the benchmark. Obviously we intend to take it up, hopefully that'll happen. FY23 was impacted by a number of factors, some of that we've spoken about, but just to kind of re-highlight, let's say relatively speaking, for the last few months, what happened was that the small cap and mid cap part of the market did far better. We were relatively underrepresented there. We were overrepresented in some sense in the relatively large cap part of the market, which did not do that well. Secondly, this entire shift that we saw in the market, wherein what is generally spoken of as value kind of stocks, though we don't believe in value investing or growth investing, we believe a good business is a good business. But just to kind of help understand the way market thinks about it, so value kind of investing or those kind of stocks did relatively way better, versus what we are more focused on is growth style of investing. Thirdly, a few of the sectors we were relatively underrepresented in that did far better. So we realized that and we made those changes. So, if we talk about the investments or the capital expenditure side of the economy, we were not present to that extent in that space. We have considerably increased our presence over there, the benefits of which also we've seen to some extent in this financial year, and hopefully that will kind of increase going forward. So that was the, let's say, third key reason. Fourth reason were that, there were some mistakes that we've made, which obviously one realizes only in hindsight. So just to give an example, Gujarat Gas was one of the stocks which we used to own. It did very well for us, contributed to portfolio returns for a good while. And then what happened was that due to the Russia-Ukraine conflict, we saw gas prices reaching all-time highs. And gas was, because Gujarat Gas used to import a large quantity of gas, its margins and hence growth got severely impacted. So there were a few stocks in which such instances of global macros kind of played out, which also hurt our performance. Maybe, we could have sold the stock earlier than we did sell. So those corrections also we've made in the portfolio, wherein we held on to a position assuming that this global macro will kind of alleviate itself, but it did not, and hence we exited that position. Part of which also impacted our performance this year, while our performance this year is in line with the benchmark, but let's say the chemical sector, given that there was a large destocking cycle in China, wherein China goods were sold, chemicals were sold across the world at far lower prices, which impacted growth as well as margins for Indian companies. So that also dragged down performance in this quarter. So in this financial year, so what we've done is we've made some of those adjustments in the portfolio. So we believe that a lot of the tweaking, plumbing, changing, which is a continuous process in investments, we are doing and will continue to do. Some of the things, I think, there are phases in the market that happens, which kind of drags down performance. And when those phases pass over, over a slightly longer term, over a longer period of time, ultimately good quality companies and higher growth companies, because they build good businesses over a period of time, that kind of reflects itself in stock price performance as well. So some of it we believe is going to happen in a natural way as well. To that extent, we believe that there is a good underlying valuation potential which is latent in our portfolios. So that is also going to happen. Some of the changes also we've made. So given that the earnings growth trajectory is more like 25% in the portfolio that we discussed, and the changes, we believe that things should do better for us over a period of time.
Thanks again, Sandeep. Again, reminder to all the participants, you can type your questions on the chat box. We shall try and answer them. Now, a bit on stock-specific questions, which you have gathered earlier on, as I said.
Sure.
I have added on IOC, and when IOC came in, obviously question of HPC and another name comes into mind. So you take on that, and then I'll go by one on the stock-specific questions.
Sure. So IOC is the largest and the most complex refiner in the country. IOC has a greater proportion of refining business contribution to its profits versus, let's say, an HPCL, which has a larger component of marketing margins coming in its profits. We are relatively more positive on the refining cycle. We believe that the refining cycle is on an uptrend for the next 1.5 to 2 years. Global refinery capacity addition is going to lag demand growth, and hence our selection of IOCL. IOCL is also undergoing a very large capacity expansion program, which is also going to hold in it good stead over the longer term. Valuations are also very comfortable. So, we have a roughly a 3% kind of a position on IOC in the portfolio.
Okay, and that is one of the reason behind, it is better placed in terms of the other names.
Yes, so right. So, a refining business we believe is relatively stronger. So refining component for IOC is higher than marketing. While marketing is going to be fine, but we are not as bullish on the marketing cycle as we are on the refining cycle. Marketing is a relatively larger component for HPCL, so that's the second reason. The third thing is that IOC is the largest as well as the most complex refiner in the country. Also, it is undergoing a large capacity expansion program, which gives us very good long-term growth visibility as well. So, it's a combination of all of these 4-5 reasons, and valuations are also relatively attractive.
Great. Now, as you already covered during your presentation, that capital investment side of the economy, where we are trying to focus more right now, we have also taken a lot of stocks there. Like in that context, we have also added L&T. And are we looking into more such names? And if L&T, why not the new age infra or manufacturing names?
Right. So yes, we are looking at more such names. What has happened in the market, though, is that the valuations in the sector have run up quite a lot. We are very cognizant about the margin of safety at the time of buying the stock. So only in businesses where we are relatively more sure of long-term growth visibility, we would definitely like to add more to the portfolio. L&T itself is getting into a lot of or expanding into newer areas as well. So, it is looking at, let's say, electrolyzer manufacturing. While defense is not new per se, but, the opportunity is kind of expanding quite a lot. And, L&T is present in that space as well. It is also getting into, fab designing and all of it. Very, very small, but so, it is also trying to do a lot of new things. We are looking at newer manufacturing spaces as well, and we are looking at taking exposures in those as well. So yes, it is not only that we are looking at the older age businesses, we are looking at newer age as well. And it is right to say that the newer age businesses will have a far higher growth. Growth is something which we like. And wherever we are convinced that the longer term growth is going to be there at good returns on capital, we will invest in it. Some of those newer age businesses valuations are not to our comfort levels, so we will be gradual, but we are definitely very interested in that space.
Great. I'm sure that will be more so evident in the future, quarterly calls as well, whenever we do a certain addition or changes in our portfolio.
Sure.
Your view as well as on, we have added Sona BLW recent past, and also you can throw some lights, though different, that KI Industries. Your views on those particular stocks at this point of.
Right. So Sona BLW, has a 7% global market share in differential gears and assemblies. It is geared to the rising electric vehicle segment in the auto space. It is, also trying to, get a larger share of the OEM spending on autos. It is, let's say, increasing its share in, the electronics and the electrical component of spends by auto companies. This is a relatively technologically intensive business. And it really depends on the long-term relationships that a manufacturer has with the auto OEMs. And all of this infrastructure, technology, relationships, expertise, skill, processes at a global level is present with Sona BLW. Its order book is strong and large. We see it growing as well. So, that is the reason for us to get into that space. Automobiles is one of the largest manufacturing industries globally. And there is a large disruption happening in autos in terms of, EVs gaining precedence over ICE vehicles. And Sona BLW is geared to that space. As far as KEI Industries is concerned, KEI Industries is one of the largest manufacturers of cables and wires in the country. It's amongst the top 5 players. And one of the key reasons that we like it is that it has a growing component of its B2C business, its consumer business. In its consumer business, it is expanding its distribution reach as well. In its consumer business, its product currently sells at a discount to the market leaders who have a far higher market share. That discount is going to narrow over a period of time. And that is also going to aid its margins. It is also expanding its capacity, which is going to support its volume growth. It also has a good share in exports. It is increasing its presence in more and more geographies. It is the only company in India which has technological expertise in collaboration with companies to manufacture EHV cables above 400 kV, 220 kV, etc. And that also holds it in very good stead. As far as it's that segment of the market is concerned. So it's all of these reasons combined because of which we like the name. And it continues to generate good growth in excess of 15% at very good returns on capital.
Great. Thanks for the answer, Sandeep. Again, a small reminder to all the participants as we are nearing the end of the call. Please type in your questions on the chat box. We shall try to answer them. We have got a question here that it seems, I'm just reading out the questions which have got out here. Though we have tried to address what are the themes we are working on, it seems that we are playing catch up on themes like private capex/infra in the last 12 months. What are the forward-looking themes that we are working on that and which can actually create alpha in the portfolio?
Sure. Could we have gotten into some of these names earlier? Maybe the answer to that is yes. It is not necessary. It is not really a catch-up. It is just that we have greater confidence in the longer-term growth outlook of these businesses. We might have taken, let's say, relatively somewhat more time than we perhaps should have, but it is not really for catch-up per se. It is just to kind of build that conviction and confidence that the growth is for real and for a longer term time horizon, and then to kind of identify the companies which are going to be the key beneficiaries of the same. Newer themes, high growth businesses, opportunities kind of keep on coming in the market all the time. Historical experience suggests that some of these could be fads, wherein growth could really come in for a couple of years and then fade away. In some of these, identifying the right winner becomes difficult because a new age sector or a high growth sector will see a lot of new entrants, because in today's world, capital is also relatively easily available, both equity as well as debt. Given the high growth prospects, the entrants in a business are many. But generally speaking, winners are going to obviously be a few only, and identifying the right winner then becomes a challenge. So we want to be very sure of what we are getting into, given the fact that we hold relatively concentrated portfolios and maybe for a longer duration of time as well. So as far as the opportunities that we are evaluating, might not be able to discuss them as of now, but we continue to evaluate businesses which are geared for, let's say, import substitution, which present a large manufacturing opportunity, which present a large export opportunity. So it could be infrastructure, it could be autos, it could be manufacturing. All of these spaces we believe are likely to do well, and we are exploring them. It's not that only these spaces are going to add alpha. The positions that we are holding on obviously the belief is that they will also do better than the market. If at any point of time, obviously, we realize or our belief changes, then we will make those adjustments and changes to the portfolio, and get in names which we believe have higher growth potential and will give alpha.
Great, Sandeep. On this, a follow-up questions to you again from the chat box itself. That when you speak about the theme, has it happened in the past that we have looked into a theme and that has not really worked for us? And has there been any example of such at this point of time in front of you?
So I would say that infra itself, in some sense, has been such a theme in the past, wherein we've seen growth in spurts and phases, in short cycles, and the growth has not panned out for a longer period of time. While there was a lot of exuberance, hope in the short term, stock prices did well, earnings growth came in, there were a lot of new players that entered that business, and then it kind of petered out. Maybe it could have been due to lack of policy support, maybe it could have been due to lack of execution capabilities. uh, the environment was not conducive, funding was not easily available. There could have been a host of factors because of which expected story did not play out. But yes, that was one of the sectors where it has happened in the past.
Thank you.
I would actually say chemicals to some extent is also been, while for a very short period of time, last few months, couple of quarters for the chemical sector has been painful, because it was expected that after reopening, the Chinese economy is going to pick up. That did not happen, and China actually, in some way, in some sense, dumped material, and that impacted the margins of the chemical company. So, while the longer term story we believe is still intact, transitory pains could also happen on an intermediate basis.
Thank you. We're almost near to the end of the webinar. I'll take one last question. And this is a question to Sandip Bansal, a fund manager, right? When like growth and value are the two sides of a coin, as we call it, right? For example, a style does not work. For example, the growth style, let's say where we are into, has not worked for us. So, what becomes very important for a fund manager to do that point of time? What generally a fund manager or what Sandeep will do when a particular style does not work that point of time in benefit in terms of the return to the investor at large?
No, that's a great question. Firstly, whenever the market is a continuous, constant, and real-time feedback mechanism, so when that happens, what it leads to is obviously self-reflection as to whether what one is doing is right or not. So it kind of makes one think harder, delve deeper into issues. But what we definitely don't want to do is go outside our core philosophy. So we revisit all the aspects of our thinking, thought process, evaluation, companies, portfolio, etc., to see what it is that we are not doing right or getting right. We expand our horizons, do more extensive work, and do more intensive work as well. If we find that if there are certain spaces, certain aspects that we miss, then we obviously correct them as soon as we realize that we are not getting it right. If there are things which we believe as doing well in the market, but it does not fill our core philosophy, we are fine to leave that. So let's say, if relatively lower quality businesses are doing well, or if let's say there is a cyclical upturn in a commodity business, which which is not our core style, we are fine to leave that, because as it is important to know what to do, it is also important to know what not to do. In the investment world, obviously all the time provides a vast number of opportunities, It is not possible for any portfolio to participate in all of them. So every portfolio manager has to choose the opportunities that he wants to participate and the opportunities which he does not want to participate in. So, such kind of opportunities which do not fulfill our portfolio criteria, our philosophy parameters, we examine them, but we are, fine to let them go. Sometimes it could happen that, what we used to believe or what seemed like maybe a value stock, if there is an underlying fundamental structural transformation or business change that is happening, either in the landscape or the management, or the sector, then obviously, we kind of examine it more closely. If there is a change that is required in a thought process, we go ahead and make them. Sometimes there are just phases in the market which we have to bide by, wait through. What we believe is that ultimately, if we are buying good quality companies which meet a return on capital, balance sheet, management criteria, and good growth businesses, they will lead to shareholder wealth creation and investor wealth creation.
Great, Sandeep. And what I took back from this particular answer of yours, the investment is not a democracy. Process and philosophy, the bedrock of any investment, and that should be the core. We should not deviate from the core from which we started off. And I guess that ends our webinar. And I'd request Sandeep, would you like to give some closing comments, more so in respect to the outlook of the portfolio for the next financial year?
Sure. So just in a financial year perspective, it might be difficult, but overall, if we look at it, the earnings growth parameters of the portfolio continue to be in the 25% kind of a ballpark range. The return on capital, balance sheet matrix, management quality, and all of that, it continues to do very well. We have geared the portfolio more towards the industrials, engineering side of the economy. That now roughly forms around 1/4 of the portfolio. We continuously will evaluate more opportunities as they come and they meet our criteria. So those changes will continue. The ongoing quarter in terms of performance has been good for us, luckily. We hope that, the changes that we make will, benefit us going forward as well.
Thank you so much, Sandeep. With this, we conclude our today's call. And thank you all the participants for attending the call. And we shall be sharing a recording of the same shortly. Thanks for all your patience listening. And it concludes the call for the day. Thank you, Sandeep.
Thank you so much, friends. Have a good weekend.